Today I'm going to talk about one of the most misunderstood home loan programs out there. What is a reverse mortgage? It works completely different than a traditional, what I'll call forward mortgage. And so let's start there. With a forward mortgage, you're borrowing money to either purchase or refinance a home that you currently own. And you are going to be set up based on a payment plan, based on the amortization schedule of the home loan that you're taking out. So in that case, you're paying a payment every month. That's what we'll call a forward mortgage. Well, a reverse mortgage works the opposite of that, in that you are taking out a mortgage, but the mortgage is now going to be based on age and equity in the property. And that equity is what is used to pay essentially the payment on the home loan. So on a reverse mortgage, you don't have a monthly payment. However, you will have a payment for property taxes, homeowners insurance, and HOA. And that's really important because if those things are not maintained and paid, then you could be in violation of the reverse mortgage, and that causes a whole bunch of complications. So let's dig deep into HUD's reverse mortgage, which is called a home equity conversion mortgage. So HECM. HECM, you'll see it out there in marketing material, and maybe you're getting a solicitation in the mail that's referencing this HECM. That's what it is. Essentially, that is FHA's reverse mortgage. Now, this program is one of those where it has so many different applications, but I really want to kind of just dive deep into just the skinny on it, the basics. If you currently own a home, and let's say you don't own anything on it, so you've worked hard, you paid off the mortgage, now that home is free and clear, it has no liens attached to it, and maybe the value of that home is, let's say, $500,000. Well, based on rising costs, or maybe you've lost a spouse, so your household income has gone down, there's a variety of reasons why one may want to consider leveraging a reverse mortgage on a home that they currently own. And it could be any of those things. So right now we have a borrower who currently owns her home. It is free and clear, but she has about $80,000 in credit card debt that she has racked up, and she only receives Social Security. So her Social Security income is about $1,800 a month. Well, she's struggling to not only pay her taxes, her insurance, and her HOA, but also the minimum payments on her credit card debt. And so her financial planner referred her over to us to kind of just inquire, what would it look like if she were to leverage her home to put a reverse mortgage on it, so she still won't have a house payment, but now start to access some of that equity to be able to not only pay off her credit card debt, but give her a line of credit on her house that she can access for the future should she need it for things like maybe the AC goes out, or maybe her car needs work, those types of scenarios. So the reverse mortgage is really just a cool loan program that can be beneficial, but there's so many moving pieces to it that it can be confusing too. So the thing to know is reverse mortgages, specifically the HECM, again, these are backed by the federal government. These are non-recourse loans, which means that once the borrower passes away, that debt does not transfer to heirs, which is really important. And the other piece of this when it comes to heirs is we want to be sure that the senior that's taking out the reverse mortgage, that their heirs are aware of it, because sometimes heirs have concerns because that could be their inheritance. And so having these conversations up front and really making sure all parties understand what is happening to the property's equity in a reverse mortgage scenario. Going back to the gal that we're currently working with, her house is worth $500,000. She is 72 years old, and she's going to be able to tap into funds that she's going to get back at closing. She's going to be able to pay off all that credit card debt, and now she's got a line of credit that she can access whenever she needs it, and she may never need it. What's happening though is now she has a loan on the property that is accruing interest, and in this situation, because it's backed by HUD, mortgage insurance. Now the equity of the home is what's paying the interest and the mortgage insurance. Again, it's reverse. So instead of a traditional mortgage where you're paying down that principal balance, in this scenario, the principal balance is increasing unless the borrower wants to pay the interest and the mortgage insurance on it monthly, so then the principal balance is not increasing. But that's in effect how it works. Now let's move to another scenario, which is very common. We have a lot of people that are moving here. Maybe they've spent their whole life living in a different part of the country. Let's call it the Midwest, because we have lots of people that love the desert that move and relocate here from the Midwest. And let's say that that person has sold their house and they've walked away with $350,000. And they're going to come to Arizona and they're going to pay cash for a house. But when they get here to Arizona, the house that they want is really closer to $650,000. So in that scenario, they don't have any other cash to pay cash, so they would have to have a payment if they took out a loan for $300,000, and they just don't want a payment because they maybe haven't had a payment for 20 years. A reverse mortgage also solves for that type of scenario, because if they purchase $650,000 purchase price, they use their proceeds from their seller of their home in the Midwest at $350,000, then essentially that other $300,000, the difference between the $350,000 that they're going and closing with and the remaining due on that purchase, that $300,000 is now being paid for with the equity that they put down on the house. So it's completely foreign and completely different than, again, traditional forward mortgages. When it comes to the myths, and let's talk about that. A lot of people think that the bank or the lender can take your house back. That's not how it works in reverse mortgages. There are some rules, and the HECM reverse mortgage requires that the borrower live in the house as their primary residence, and they maintain the home, and they pay their property taxes, homeowners insurance, and HOA. So that's the key. And as long as they are doing that, they can live in that house for as long as they're living or until they can no longer remain in the home. So in that scenario, let's say that maybe they've been in the reverse mortgage for 20 years and they pass away. At that point, the reverse mortgage lender is going to look at the current market value versus the balance that is on the reverse mortgage. Now, let's say that the current market value is $500,000, and let's say that there's $400,000 on the reverse mortgage. So technically, there's still $100,000 in equity there. In that scenario, the heirs would sell the home just like they would if it was free and clear or had a traditional forward mortgage on it. And then they would walk away after closing with whatever equity is left. So that's scenario one. Well, scenario two, let's say that the market value of the home is $500,000, but let's say the balance on the reverse mortgage, because the borrower has been in the reverse mortgage for so long, that let's say the balance of the reverse mortgage is now $600,000. So now there's a $100,000 debt owed between the balance and the current market value. If the borrower passes away in that scenario, that debt does not transfer to the heirs, and that's why this non-recourse labeling of this loan is really important. So in that case, after the borrower passes away or is no longer occupying the property, if there's more debt owed on it than the current market value, then HUD comes in and takes back the property and does not pass that debt along to anybody. In that scenario, the HUD mortgage insurance premium pays the difference, and that's the key. And so another myth that we often hear, and it's not really a myth, I mean, the reality is on this HECM reverse mortgage, that mortgage insurance is part of how the program is funded. And it's specifically that way to be able to pay any deficiency if somebody does pass away or has to move out of the house. And it's specifically designed to use that mortgage insurance fund to go in and pay the deficiency if in fact there is one. That way that debt is not passed on to heirs or anybody else. And to that note, the title still remains in the borrower's name until the point that they pass on. And again, in that situation, if the heirs sell the house, then they sell the house just like they would in a traditional sale. And if there's more owed on the house, then HUD would come in and take back the house and pay the difference of what's owed versus what is the current market value. Now, another cool thing about HUD and FHA on this particular program is that, let's say the heirs are really tied to the house emotionally and they're just not ready to sell it, but maybe there's more owed on it than what the current market value is at the time. FHA allows for the heirs to come in and purchase that house at 95% of the current market value of the house. So again, this is a program that's really designed to not only help seniors leverage their equity to be able to live life if incomes change based on one spouse passing on, or as rising costs occur, or just to leverage to be able to live the life they want, or home improvements or car repairs or those types of things without having a mortgage payment. That's the key here. But unlike a traditional mortgage, it's all based on age and equity position. That's what drives a reverse mortgage. So let's look at a few more scenarios, specifics to help kind of bring light how this program works. We'll focus on downsizing. Let's say that somebody has a house to sell and their value of their current home is $500,000 and the home is free and clear. So in that scenario, they're going to sell their home. Let's account for roughly 8% for commissions, closing costs, whatever on the sale of their house. That's going to leave them with roughly $460,000. Let's say that they're downsizing, so they want to go buy a house for $350,000. They can do that. And traditionally, then now they've got $110,000 left in their pocket. So, they have $460 net any expenses on the sale. They go buy $350, net, $110,000 cash can go in their pocket. However, if they were to leverage the reverse mortgage, they could do so and still not have a house payment, but keep more cash in their pocket. So here's how it works. Same scenario, they're selling their house for $500,000. Let's call it carrying cost to sell the house is roughly 8%, so $40,000. Net, that $460,000 cash. And let's say they're 70 years old and they leverage a reverse mortgage. In that scenario, the cash out of pocket is roughly $153,000 instead of the $350,000 if they were fully paying cash for the house. So $153,000 cash out of pocket, which means now they've got $263,000-ish that they can keep in their pocket and still not have a house payment and downsize and accomplish their goals. So that's kind of one scenario of how it works. All right, so let's go scenario 2. And in this situation, somebody has a house for $500,000. They want to sell it. And maybe that the house that they want to purchase or the area they want to purchase in, that price point of that house is $700,000. But they haven't had a house payment and they don't want a house payment. Let's kind of walk through what that looks like. So scenario 1, without using a reverse mortgage, this would be just a traditional scenario, not reverse. Sell the house at $500,000. Account for an 8% carrying cost, commissions, fees, etc. Net $460,000. And in this case, the purchase price of the new home is $700,000, let's call it that. So they would need to have a home loan of $240,000 or reach into their other assets to get the cash to pay full cash for this house. So come up with another $240,000. So they would avoid the house payment in that scenario. So that's scenario 1. But let's look at that in the reverse mortgage lens. So again, they're selling a house for $500,000. They've got an 8% carrying cost for the sale of their house. They net $460,000 cash after the sale of their house, and they want to purchase a $700,000 house. Let's assume that they're 70 years old, and in that scenario, they're only having to come out of pocket with roughly $305,000, which means that they still have $65,000 cash in their pocket that they would not have to use. So that's kind of just a difference in how the monies would work between a traditional forward mortgage and a reverse mortgage. Working with an experienced lender that really understands reverse mortgages is absolutely key. And it's such a unique loan program that not a lot of lenders either offer it or are very well versed in it. The good news is we are. So if you or a parent, a relative, or a client have questions about how to leverage a reverse mortgage to help them meet their goals, do not hesitate to reach out. You can click below to schedule a 15-minute consultation. We'll just kind of walk through the details and give some perspective on if a reverse mortgage can help achieve your goals. And lastly, the biggest pushback we get from people is that the loan is utilizing the equity in the home. And that is absolutely the case. So if we have a borrower that is dead set on their heirs inheriting the home, then a reverse mortgage would not be a good option for them, because in a reverse mortgage situation, most often what's happening is the equity is starting to be used to pay for whatever the goal is. Again, if that's paying off an existing traditional mortgage, whether that is buying a more expensive house and not wanting a house payment, or maybe downsizing and wanting to minimize cash out of pocket and still not have a house payment. So many different nuances to it. But the key is that in a reverse mortgage, this is the most important thing. Outside of paying your taxes, your insurance, and your HOA, that has to be paid and it is not paid through the reverse mortgage. The second most important thing is that the balance on that mortgage is growing. You do not have a house payment monthly because the equity of the loan is paying the interest on the loan as well as the mortgage insurance. That's why that balance is starting to grow. So depending on the market value of the house, there could be a point where there's maybe less equity in the property or maybe no equity in the property. It really just depends on what's going on with market values. The other thing to know about reverse mortgages though is they are structured based on a 4% annual appreciation rate. So it's not like FHA wants to come in and take back all these properties. The actuarial tables that they use to determine how the numbers work and how much equity has to be available to obtain a reverse mortgage, etc. It's all based on the actuarial tables of a 4% annual appreciation rate. So again, they're not in the business to want to have homes upside down and take back a house when somebody passes on, but they could, and that's where that mortgage insurance premium comes into play. Hopefully this has been helpful just to kind of give you some insight into reverse mortgages. I know that there's so much information out there and it can be very confusing. If you have questions and you want the straight scoop for your family member, yourself, or your client, do not hesitate to reach out. Thank you so much for watching. I am truly passionate, not only just about mortgage education, but this program in particular, it can help so many people. We've seen it happen. So if you have questions, do not hesitate to reach out. And please, if you found value in this, please share and subscribe to this channel for more mortgage education. Stick around for my next reverse mortgage video for the 5 myths that I'm going to debunk about reverse mortgages.